morning to you. Today is Wednesday, 21st of January 2026, and my name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. And today I'm talking about the fastest way a clever acceleration plan turns into a slow motion problem, if you may. Let's imagine that you spot a capability gap, you decide to buy a platform rather than build one, which is quite sensible. It's a very good move. Then the regulator reminds you control changes are not a commercial detail, they are an approval event. So, as a context for today's theme, which is control changes, here is a live case I am watching. And just to give you the context, it is a listed alternative investment market company that has made a big regulated bet. It is backing an applicant UK small and medium enterprise challenger bank, which is still in mobilization. And I spoke about mobilization Monday and Tuesday, so you can watch those videos if you want to more details about mobilization. But while the bank is progressing, the listed company moved to acquire the plumbing, if you may, a regulated platform offering current accounts, FX, and business finance. The disclosed terms are plain and very instructive, by the way. It entered into a conditional agreement to acquire 100% of the platform for £1 with an implied enterprise value of circa £9.5 million. It also put in place a working capital facility of up to 600k from existing resources to maintain the target while the deal awaits approval. So in short, regulated companies back in a bank company that is acquiring a licensing and is in the mobilization period at the same time, but all what this bank is going to do, like current accounts, FX, lending facilities, etc., and acquired for £1, and also they put there a breach of working capital for 600k. So, and completion is explicitly conditioned to two things, right? So we have this scenario. Number one is the Financial Conduct Authority regulatory change of control approval, and the number two conditional is shareholder approval to amend the investing policy to allow majority ownership. So if you're sitting in a board with this scenario, the issue is not, this is a good platform. The issue is whether you're governing a clock, which is a timeline, the control, and the cash while you wait, right? Because remember this condition to two things, is the change of control approval and the shareholder approval. So you have two approvals there. So let's take a look at three problems with this. Number one, the board confused signing with owning. So in this particular case, the acquisition is conditional until the Financial Conduct Authority change of control approval lands and the shareholders approve the investment policy change. You don't have a complete control yet. However, you still carry expectation risk, timetable risk, and often funding risk. Number two is this situation creates a second gate, right? Gate is approval and the funding and the mobilization. But you create a second one without naming it. The Financial Conduct Authorities is very explicit on this. If you want to acquire or increase control in a regulated firm, you must notify and obtain approval. It also states it has up to 60 working days to assess a complete notification, excluding interruptions periods when it asks for more information. That is a real timeline factor and not just admin. It's a timeline for an approval. And number three is they fund a waiting room, if you may, and call it a strategy. These deals includes a 600k working capital facility, as we mentioned, a structure in trenches to preserve operational continuity during this interim period. That can be a smart value protection, very good, but boards need to treat interim funding as a risk position with conditions and monitoring and clear stop points, so it doesn't bleed the company in terms of cash requirements. So in other words, you can imagine this. Change controls is the speed limit camera of the merging and acquisitions. You can plan a very fast route, but you still have to drive the post limit. So if there is a speed limit, it doesn't matter how short is the route, you still have that uh, constraint, if you may, to watch the speed limit. So how do you avoid mistakes? The number one mistake is treating regulatory change of control like a standard condition precedent you can project manage at the end. This is not a project management thing, it's a timeline towards an approval. So the easy fix is to run a control clock from day one. And a control clock is the board view of four things. Number one is what triggers the notification. Number two is what evidence the regulator will want or requires. Number three, what could pause this assessment? And number four, what you'll do if timing slips, right? So it's all about risk controls. Crucially, if you may, how you stop your interim funding from drifting into dependency, something that we mentioned. They have a facility for 600K, so you don't want this over depending on you. So as a board advisor, what I would propose to consider in this case, number one, as a suggestion, is build the submission around what the Financial Conduct Authority actually asks for. The Financial Conduct Authority's change in control guidance sets the baseline. You notify once you've made a decision to acquire or increase control, and you need approval before the change takes place. It also points you to the Section 178 process and the controller thresholds. So use that framework to structure a board pack, not a generic merger and acquisition checklist. And you will be surprised that sometimes these generic checklists are the ones that actually are used. Suggestion number two is treat governance and ownership mappings as the first class work. The Financial Conduct Authority's submit notification guidance is blunt about preparation. Identify all controllers, build ownership charts, explain conflicts, and provide evidence of funding. If you are dual regulated, like in this case, you also need to route correctly. This is where timetables die if you leave it late. So you have to have that clock ticking and respect it. And suggestion number three, design your interim funding so it protects value without quietly shifting control. It is, in this particular live case, the bridging facilities includes terms and protections plus warrants that lapse on completion or repayment. And the facility is described as bridging finance pending completion. Those structures exist for a reason. The board's job is to match those mechanics to govern controls, reporting cadence, and clear triggers to pause for the drawdown. So here's a board lens that I use. If you are acquiring regulated infrastructure to accelerate time to market, you are really making two bets at once. Bet number one is the asset is commercially viable, very good move. And bet number two, the regulator is comfortable with you as controller, right? So commercially viable is one thing, but then on the other side, the regulator have to be comfortable with you or your organization as a controller. So most boards obsess over the asset commercial viability and assume that the regulator is comfortable with you as a controller. So, but the bet two, so the regulator case, is where timing and credibility leaves, right? So, and in this particular listed environment, timing and credibility are like oxygen. So you need a lot of it. So why this approach really matters? This is for three things: outcomes, differentiators, and risk reduction. In terms of outcomes, health boards build a control clock that turns a change of control process into a governed timeline, with clear evidence milestones and board triggers. This matters when your acquisition is conditional on Financial Conduct Authority approval, as in this case that we are discussing. In terms of differentiator, translate Financial Conduct Authority requirements into board actions. The Financial Conduct Authority spells out the need to notify and obtain approval and set expectations for assessment timings once a notification is complete. So build your submission plan, ownership mapping, conflicts plan, and funding evidence into a single steerable board pack package in one page. Try to do it in one page. So it's just bullet points. And how you reduce risk. De-risk the interim period. When a deal uses bridging facilities to preserve operational continuity before completion, set drawdown conditions, monitoring, and stop points to support doesn't so the support doesn't become a quiet control or a liquidity problem. So the published 600K facility structure is exactly the kind of interim exposure that needs guardrails. So one action you can take today with this, in less than 30 minutes, add a control clock, a one-pager on your board pack, today's decision date, notification readiness date, likely information gaps, interim funding stop triggers, and the single owner accountable for the regulator Q&As. Excellent. So let's pause it here for today and reconvene tomorrow, because tomorrow I will show you investment policy changes, shareholder approvals, and deal disclosures can either build market confidence or create a trust wobble right when regulators and investors are paying the closest attention. And you want the best of the best showing to the world. So if you are a UK listed board acquiring regulatory capability, message me 2 words, control clock, and we'll set up a 30-minute call to understand your position and how an advisory board can map your change of control pathway, the evidence plan, and the interim funding guardrails you need to protect value. So have a great day and see you tomorrow. Thank you. Bye-bye.